G'day traders, mindset reset. It's Tuesday, day 2 on the front side of the week. Today we're going to answer some specific questions that has come in from traders, and we'll also talk about today's technical video. We're going to be talking about day 2 opportunities. Again, building your watch list, going over that. Answer some questions regarding yesterday's video about Monday, day 1 on the front side of a week. So day 2 typically expands the range, coming back to understanding that Friday's closing price is where the auction process begins from. That's the reference point at the start of the week that the market starts to establish a high and low range from. Initially, we get short-term traders into the market, we get longer time frame traders into the market, and eventually we get all time frames into the market by breaking boundaries, triggering breakouts, breaking out of markets, which comes back to understanding the concept of which setup are you hunting. And so some traders are trend traders. They feel a bias more towards trend trading. Other traders have a more tendency to reversal trading, whether that's in the long direction or the short direction. And I've put together templates that I'll be putting into the course area, PDFs of those, and I always emphasize this to traders, knowing what you're looking for. So day 1, day 2, day 3 on the front side of the week. Yesterday we had a video talking about just a couple of basic criteria to look for candidates on a day 1, a Monday. And one of the things we talked about was, in the previous video, was Friday being an inside day. Obviously that's a signal day, but we also talked about a 3-day template, a 3-day setup where we have peak formations on Thursday and Friday. One of those can be the high of the week or the low of the week. One of the most important things about building your muscle memory is knowing what a good template looks like. Now, on the day itself, I talk about 2 templates, pump and dump, dump and pump. So you have to be able to differentiate that from a market that is now on a range expansion, a day 1 runner. Like yesterday, gold was a day 1 range expansion on the opening range. That gave traders in the Asian session an opportunity for reversals early on day 2. So markets that closed in breakout. Silver broke out on the day itself. An excellent question from a trader was, why didn't silver behave like a first red day like the euro pound did last week? They're not the same. You have to understand when a market is in breakout and it pulls back to continue versus calling a pullback a first red day or a first green day. So that's a really important thing to differentiate. Markets that break out and pull back and are still in breakout are not first red day or first green day templates, especially when we are not yet into the closing range of the week. Now, if you understand timing, so day 1, day 2, day 3, markets that break out now could be on a trend continuation trade. So breakout, pullback, continuation, day 1, day 2, day 3 on the back side of the week. We saw markets today, NASDAQ, S&P, in parabolic templates, Friday higher highs, Monday higher highs, so 1 push, 2 push, and a day 3 range expansion on Tuesday. Tuesday, day 2 in the front side of a weekly template, but a 3-day template for a parabolic range expansion blowing off in the direction of that coil. Now, most important thing is not trying to figure out every market and where it's going and predicting. And some questions I get from traders sometimes is, can you break down this instrument and say what you thought was going to happen or why it didn't do this? And my response is always, I don't know why it did or didn't do anything. Did it have a setup? So day 1, what type of setups are we looking for? I'm looking for instruments just for beginning the week. We talked about this, markets that close and breakout, a 3-day template, a signal day, a day 1 opportunity, high of week, it's a new week, low of week on a Monday. Day 2 typically expands the range. If a market on day 2 is expanding the range, one important thing to really understand is that if a market is going on a range expansion, to not counter trend it, which comes back again to understanding which setup are you hunting. So there's front side opportunities and there are backside opportunities. As the range expands, we can now be targeting other time frame, larger risk reward trading setups, which is why I always emphasize to traders the patience to sit on your hands. And when you are going to the screen on the front side, knowing exactly what you are looking for. So there's choices. I've put together templates in the playbook, but certain traders might feel more of a bias to the short side. Some traders, I've said this before, when we're at the front side of the week, if I get a coiled market, I will take that as a trend trade opportunity because they will typically explode in the direction of where we've had maybe a range expansion on day one. Indexes are an example of that today. And sometimes, as we saw in NASDAQ and S&P, markets are coiling up at the high of day level. They broke out, they'd already come down, reversed, coiled at the high of day level, which is a template you will often see if you go back through your charts and build your muscle memory. It is not unusual to see US indexes coiling at a high of day level for an expansion on the front side of a move. Most importantly, though, is knowing confidently the setups that you're hunting and then picking one or two instruments to watch that evolve into the setup in the timing window, being patient, understanding how you're going to execute that trade, which brings me to another excellent question. A trader asked about the size of the candles on the 5-minute chart. So we saw some larger wicks on those candles. And there are two types of scenarios that traders can finesse and develop their skills on. If you have a solid thesis on the template, so a day 2 templates, I'm going to put those, today's technical video, we will have a PDF of day 2 templates that I look for on the indexes, which again are rinse and repeat, front side, back side type of opportunities. But there are two types of scenarios that traders can approach with that in mind. If the wicks are large or if it's a larger candle. Now, when I see a coiled market, my thesis always is, as I mentioned, the bow and arrow. There should be no pullback in that trade setup. So it should explode if it's a coiled market, meaning that 25 pips is my max stop. Now, if the trade candle is larger than that, or if I'm not 100% confident, I can reduce my size on that time frame, on the 5-minute candle, to open up my stop loss on that instrument. Reduce my size, my stop loss would still be the same as if it was 25 pips, but I just take a smaller position. I want to be in the trade in case it does explode to at least get something, but I'm not going to necessarily be loading the boat on this. We're on front side in this particular model. Or if your skill set dictates, you could be scaling in on the 1-minute chart to the close of that 5-minute candle. So for example, we saw an example of that on the DJ30 this morning. A 1-minute, first minute, the market spiked down. We already had it coiling, and then it reversed immediately on the 2nd minute. But as soon as it took out that opening price level, we can have a starter into the market. We now have 3 more minutes to let it retest that and enter in for that market to close on the 5-minute candle. It's already done its stop hunt down and reversed. It's a 2-minute reversal, but that's the wick on the 5-minute candle. And then when that market closed, it immediately pushed higher, and then into the high of day level. 15 minutes again, similar, 100 pip move in 15 minutes. That is what a parabolic move should do. So another question from a trader was, how long would you hold on to a trade if it's moving slowly? Now, the example this trader was using was oil. And oil was on a range expansion reversal, 100% expansion of the high low of today's coil sideways at closing price, a market that closed in breakout. Now, there's two types of situations with that. You can remove partials to lock in the bulk of that profit. Like my friend Steven, 2 to 1, 3 to 1. You can use your stop as a projected target area, your stop and entry area for a target, and also leave a trailer in for that full range expansion, which oil did complete. You have to have the confidence. So if you've done the muscle memory and you've got the right setup, what is the percentage of frequency that it often hits that range expansion if that is the target? And if it's a high percentage situation, lock it in take some out, lock it in, walk away, leave it. You can have a trailing stop. You could have, when I say trailing stop, you can adjust that so that at least if it does come back on that last position, that you're still going to lock in some profits. I don't trail things. I typically will exit on movement through a level. If I'm going to leave it, I'll lock it in with a profit buffer so that if there's a spike or anything, it still takes me out with some degree of profit, but I will lock it in and let it go to completion 90% of the time or greater. In retrospect, I had taken profits too early when the market would complete the range expansion in those moves. So I have full confidence that when the setup is proper, we had a very well-defined rectangle, high-low, and it usually will complete that move. So again, comes back to building that expertise, having the confidence through building your muscle memory and repetition of just going back through the same setups and knowing that that market will complete that move. So just as opposed to guessing and trying to short something or buy something and, how long should I hold on to it, is not a good strategy. Have a very well-defined method of why you're entering that trade. What is the template and the setup on this day? Day 2 typically expands the range. That market had gone on a range expansion, closed and breakout, coiled up high sideways. Markets that coil sideways are getting ready to have an explosive move potentially. And that market broke down, made lower lows, pumped up at 9 a.m. and engulfed, coiled underneath of closing price and went on a range expansion. So it was an excellent trade taken by traders. So hunting for markets that are up high or down low is not always the smartest thing to do, because you on the front side, you're trying to maybe counter trend a market that's going on a range expansion. So recognize what a range expansion coil looks like on the front side. And if you're looking for that on the backside, a potential reversal range expansion coil, the market that can reverse and go on a range expansion. That's where you get asymmetrical risk reward. Now, in closing, everything is simple as you make it. So if you're struggling, that means you still haven't defined parameters for what setups are you looking for. Now, I went through that yesterday on the video regarding just hunting for basic 3-day setups heading into the front side of the week. Thursday, Friday, Monday. We can be doing the same thing heading into a Tuesday, a Friday, Monday, Tuesday. Sometimes Friday's an inside day, so maybe it involves a Thursday, maybe it involves a Wednesday that's dumped down and coiled into Monday, Tuesday for a range expansion target, whatever that may be. But what instruments have given us a potential signal the night before? Closed and breakout, an inside day. We had an inside day on the DJ30. The market broke down prior to our New York Open, came back up underneath closing price, Friday's closing price on top of Monday's closing price, coiled for an explosive range expansion back towards the high of the day before pulling back and continuing that move. As I mentioned, the NASDAQ and S&P both pushed higher in the London session. Paul Tudor Jones, markets that are going on range expansion. When it goes higher, that's a range expansion prior to the US Open. That's a dump and pump template. Now, if you don't have the confidence to take that when it's up high in a coiled market, again, that may not be one of the templates that you need to trade. Now, even though it's moved and gone on a range expansion, that doesn't necessitate that you have to have taken that trade. Which trade setups have you mastered? Find the ones that look like that. And if it goes and you're not in it, it doesn't matter. It doesn't matter. What setups are you focused on? And just worry about finding those when they show up. If the market moves, if it does all kinds of stuff and you're not in that move, that's all things that are in your head that you think you've missed out on. They want you to think that you're missing out on moves. FOMO, fear of missing out, chasing moves, chasing movement, following markets because they're moving and looking for some trades. That's not following and hunting specific templates that rinse and repeat that you can have a high degree of confidence in because you've traded them over and over and over again about, number one, how should this behave into that entry? What type of template am I in? Is this a nail and bail, or what should it do? What are the signals? What are the potential signals that this template's given me already that it's going to go on a range expansion? Or should I take the money and run because it could come back and continue later, or whatever those things are. Master your setups, have the confidence and the discipline to execute. Lock in the money, walk away. Don't be tempted. Don't be playing around. Don't be hanging around for more. Make your rules concrete. One and done. It's day 2. We're on the front side of a week. There's going to be plenty of best trade candidate opportunities. CPI tomorrow. Master yourself. Master your craft. Have the confidence to stick to your plan. Don't deviate from that plan. Don't bend the rules. You bend the rules a little bit. I always joke around, like, it's like some of the jokes, you can't get a little bit pregnant. You can't, if you shoplift a chocolate bar, is that okay? Is just because it's a little thing. If you take a couple of trades on the side, even though they're not part of your building your trading plan for your trading business, is that okay? In my books, it's not. Very cut and dry. There's black and white. There's no gray area. You either stuck to the plan and you executed and did everything flawlessly to the best of your ability, or you bend the rules and there's nothing that's rinse and repeat, and it just kind of keeps changing day to day, no matter what day it is, no matter what market it is. You're just looking for things that are moving and trying to trade them. So get very, very tight on what you're doing. Stick to the plan. Don't deviate. Keep it simple so that you can rinse and repeat that, and then stick to that and execute it day in and day out. Have a great day, traders, and may the markets go with you.